Hello, everybody. Welcome. It's that time of the year when we want to see what lies ahead. Andrew Pancholi here from the Foundation for the Study of Cycles. And also we've got Akhil Patel with us from the Secret Wealth Advantage. So what we're going to do in a minute is quiz Akhil and combine our thoughts and see what we can see to be ready for 2024. Before we get into this, a bit of background on what we will be discussing is, as you know, our dear founder, Edward Dewey, was really embracing the 18.6-year cycle that he really found was present in most of human behavior, natural behavior, geological behavior, all sorts of stuff, multiples of that cycle. And of course, in the through human behavior, the interactions of commodity and stock markets. So with that in mind, Akhil has recently, over the last 6 months, published a book which takes a very deep dive into this 18.6-year cycle that's identified. And we've brought Akhil back so that, first of all, he can explain the overview of the 18.6-year cycle. We'll have a look to see how it played out in 2023 and see what lies ahead. And we'll also throw in some other bits and pieces from other cycles that we look at and chat about. So, Akhil, welcome back. Lovely to see you again.
Really good to see you, Andy.
It's always a pleasure speaking to you, my friend. So we're really looking at 2024. So where do we stand within the big picture of the 18.6-year cycle that you write about, which is exactly the same as what Dewey and, of course, our friend and your business partner, Phil Anderson, also mentions. Of course, Phil has now gone to ground to research Morgan and other bits and pieces. So, so Phil, Akhil, take us away. Give us the big picture, please.
Okay, maybe for your listeners who are not familiar with the cycle, maybe if I just visually illustrate how the cycle is structured. So I'm just going to share my screen. So what I have on this diagram is basically an overview, which I've taken from this illustration in my book, page 23, which basically shows how each cycle is structured. So it's an 18.6-year cycle on average, actually very little variation. It's the main boom bust cycle. So when you hear about major financial crises, that's usually the end of the cycle. And what you tend to find is it's got four main phases. The first one is what I call the recovery, which is basically the start of the cycle out of the prior crisis. Things recover, governments are successful in bringing the economy back to growth. Property markets recovering, stock markets getting back to growing again, and businesses are expanding. A few years in, you tend to get the second stage, which is a mid-cycle recession. When you get periods of expansion, sometimes things can go a little over the top. You get a minor recession, generally tends to be fairly short, not very significant in terms of things collapsing. Typically, I mean, sometimes it does vary. Governments stimulate their way out of it. They're quite successful in doing so. They get a lot of credit for doing that. And that sets the stage, the scene for the third stage, which is the boom, which is much more speculative because people have survived the mid-cycle. You tend to find there's much more bank credit available. Governments have stimulated by, infrastructure programs, which is, good for the economy, and so on. And that leads into a much bigger real estate boom. A few years before the peak, you get a really kind of feverish speculation period where everyone is jumping in. There's a lot of FOMO, markets at all-time highs. You hear lots of stories about people making unimaginable wealth from property and other things, and things really go over the top. They lead to a peak, and then because the banking system has been involved in fueling the prior boom, when things turn down, it brings down the banking system, and it takes several years to sort that out, and usually get a major banking crisis, sometimes a sovereign currency crisis, and almost always a fairly significant economic depression. And that period completes the 18-year cycle. Each of the phases are roughly, each of the expansionary phases are roughly 7 years in length. And then the crisis period at the end is about 4 years or so, which completes an 18-year cycle. So that's kind of an overview of how the cycle is structured.
Okay. But before we go any further, let's just so that's interesting. So that's the sort of abstract of it there, the theory of it. If we were to just put that into practice, Where does we begin that cycle in 2011 to 12, yeah, as a follow-up from the global financial crisis. And if we were to back test that cycle going back a previous generation, sorry, or previous cycle effectively, sorry, it is a generational cycle as well. I'm jumping ahead here. It would take us back to about 1993. Is that correct?
As the start of the previous cycle,
Yeah, as
yeah,
a
around
start
then.
point.
Yeah.
So
Yeah.
we've got an anchor point of 2011, which is the recovery from the global financial crisis. And then after that, we would go back to 70, from the prior 93, would go back to around about 75, which would be the
Yep.
OPEC oil crisis, significant depression, global recession, and also really the major low of Western stock prices as we know it. Is that
Yeah.
correct? Yeah.
Yeah, so late 74 was the low in the stock market. And often the stock market lows before the cycle gets to its really kind of end point. Because stock markets are always ahead of events, as you know better than I do. And I think you made a very important point that people refer to that sort of early to mid 70s crisis as the oil shock. And it's true that OPEC doing what it was doing had a very significant effect on the world economy. But what people tend not to realize is that we were moving down into a economic depression anyway, because real estate prices were collapsing, banks were coming down, they were needing to be bailed out, and so on. And so, regardless of whether or not the oil shock had happened, we would have had a very significant economic difficulties. Of course, the oil shock then made it even more difficult and made geopolitics very difficult, and it was a very messy decade. But it would have been a pretty significant crisis anyway.
No, exactly. So, I mean, as with these things, just for all our members here at the foundation and our other cycles friends that are watching this, this whole idea that a single cycle tends to sort of reflect a pattern, but the overlay of or synchronicity or alignment of multiple cycles will create a shock or an event. So I think that's a pretty important point to make. So with this in mind, Akhil, how well has this present unfolding of the cycle since 2011, how well has it performed? What have we seen? I mean, can we just perhaps we can bring the chart back up again there and talk us through what we've been seeing since 2011, and are we seeing a complete alignment? Have there been some misses? And because I always find that by every now and then, if we find in either an inversion or a lack of alignment, then there's another cycle hovering around that we must put our Sherlock Holmes hats on, our deer stalkers, and find the rogue there, because there is no such thing as a black swan. So yeah, take it away, Akhil.
Yeah, sure. Okay. So bringing back that chart, so you've got the overview. So you would say that the start is around, as you say, 2011, 2012. I should point out, there's not a single day when a cycle starts. It's usually a transition between the end of the previous cycle and the start of the new one. And so just going by the general dimensions of the cycle, and I'm just going to move to the next slide. I'm going to come back to this after we talk about when we start talking about 2024, but just to give you an overview of the structure, you tend to find that each expansion is about 7 years in length. And so if you were saying, well, 2011 is the low in the real estate market, it's when things are starting to move around, you would already be expecting that around 2018, 2019, things are going to start slowing into the mid-cycle recession. And actually, in 2019, we definitely got slowing of the global economy. The yield curve inverted, PMI data was coming down, and so on. And then on top of that, in 2020, we had the COVID crisis, which led to a pretty sharp recession. It was actually also a short one. And as I said before, the mid-cycle recession tends to be shorter than the end-of-cycle crisis. And in fact, because of the stimulus measures, zero interest rates, and so on, we had pretty much the shortest recession in US history. So it was only 4 months, I think, officially. So that was the mid-cycle. Now, you then say, well, the second half of each cycle tends to be about 7 years in length. There's some variability as to kind of the relative lengths of the first and second half of the cycle. So if 2019 marks the beginning of the mid-cycle, you would then be thinking 7 years on from that should be around the peak of the current cycle when it really gets over the top. And so we'll be looking at around 2026 as the coming peak. And so the years 2023, 2024, I know the news has been really negative, but actually we are, I think, fairly squarely in the second half expansion. And one of the signs for me that we were there when, and people didn't realize it, is, we were guaranteed at the start of 2023 to be in recession at some point. I mean, I think economists, Bloomberg and so on, and other experts say it's virtually nailed on guarantee that we're going to get a recession in 2023. What do we have? We had a very resilient economy. It's been quite growing. House prices in the US have been growing since February, March. In fact, jobs data is looking quite strong. It's been persistently strong despite all these interest rate things, despite the fact that Fed has been talking tough about needing to, get things under control and so on. And one of the reasons why it's been so resilient is where, in my mind, where we've been in the cycle. So I think that kind of illustrates that actually the overall structure is working rather well, despite all the major sort of events, COVID, inflation, Ukraine, the stuff in Gaza, whatever's kind of been thrown at the cycle, as it were, about the global economy, it's shrugged off given where we are in the cycle.
Oh, yeah, it's fascinating. And just for those of you who are new to cycles, and I know there's people, many people now, in your early 20s that have been corresponding with, have got into this. So this might seem a long time back, but just to sort of give you the roots of this, that the beginning of that cycle was a recovery from the global financial crisis. So just for the youngsters amongst us, which we're very welcome and pleased to see.
Absolutely.
No longer an elderly gentlemen or ladies pastime. So the observance of cycles is actually pretty exciting. And of course, if you embody this at an early age, like those of you that I've been speaking to, then you've got your life made. You don't have to listen to all the nonsense that the media and governments peddle. So so realistically, this worked pretty well for 2023, right? And in fact, let me just take it back to 2020, because if we go back, I think probably 2018, I was with you and Phil in London at an event, and I know we were discussing, I had the view that 2019-20 would see a significant pullback and a market crash based on the 90-year cycle. And of course, the 90-year cycle is actually 5 patterns of 18 years. I know we get a bit of skewing with the half year there, and I remember you categorically saying, I don't think it's going to be a big pullback. And you were absolutely right. I mean, we still got a third of the market, but it recovered within weeks rather than going into a prolonged pullback. So, there's a lot of credence to this cycle, the way you look at it. And that's a big, I've certainly paid a lot more attention to it since that. So we did see that. We saw the pandemic come in. Drilling down into 2023, the Silicon Valley Bank situation, did that fit into the pattern?
I mean, you wouldn't normally expect such a major kind of quote unquote banking crisis in the middle of the cycle. But actually, I think that almost answers itself. It wasn't a crisis. It didn't really affect very many banks. And it was, I think, sort of fairly unique to the United States. So you had all these banks which were really flush with cash and so on, because there was a slowdown in the tech industry because of high interest rates. And they weren't managing their risks properly, deposit insurance and so on. And then there was some cause for some, for concern, because banks themselves weren't managing their sort of risks properly either. And so there's some doubt about Silicon Valley Bank. So everyone withdrew their money, and they could do so very quickly because there's tech-enabled banks. And the run on Silicon Valley Bank was $48 billion in 2 days. I mean, no bank has ever experienced anything remotely like that, and they were just unprepared for that. But as you saw, there wasn't a major crisis. It wasn't a Lehman Brothers moment, as a lot of people feared. And actually, the Fed stepping in with liquidity sorted it out. And I think what the thing that this will now put into people's minds is that the Fed stepping in can sort it out. And it gives a certain amount of confidence to what they do which when you get to the end of the cycle, because you have a falling real estate market and sort of a falling general real estate market, and not just in the US, in countries around the world, all at the same time, central bank actions won't be nearly as effective, or they will be effective, but it'll take a lot longer. And in the period when they're starting to take effect, people really panic. And then that feeds on itself. And that's when you get all this sort of widespread banking and business failures. And so I think we've had a little bit of an important lesson in 2023, which, as far as I can tell, not many people have really paid much attention to.
Yeah, I think you're absolutely right. I mean, from my point of view, the big panics, 1857, 1907, they were all part of super cycles. But again, all those cycles pretty much are subsections of the are multiples of the 18.6 year pattern. Yeah. So I think we do need, in 1857 would certainly tie in, 72 years previous to that. We saw a crisis, and 72 years on from that, we saw the 1929 crash, and 72 years on from that, we saw the end of the tech boom as we got into 2000, 2001. So again, the 72-year cycle there, illustrating effectively 4 rotations of this cycle. But was there anything else in 2023 that we've seen that really aligns with your cycle?
Well, we had this concern about commercial real estate in the middle of the year, and some of the headlines were suggesting it's going to be worse than the global financial crisis. Again, I'm not saying that. Well, I mean, commercial real estate is a very diverse asset class. I mean, it includes data centers, which are doing very well. And it includes, central Manhattan office buildings, which aren't, because, we work in different ways than we used to. So the office kind of parts of this commercial market are not doing great, because people are still trying to work out what the office of the future is going to be. But we're seeing in London and New York and other places that actually a lot of these districts are now being repurposed. So, I think this is another sort of indication of how the cycle progresses. It doesn't mean that everything is going up all the time for 14 of 18 years. It means that the market finds a way to resolve problems. It's only at the end of the cycle where it's much more difficult to do so, and it leads to major collapses. So that sort of, I think, was confirmation of that. We're seeing a major construction boom all over the place. I mean, there's cranes everywhere in every city you go to. That's, again, what you'd expect. There's actually quite a lot of spending going on. People are exhibiting sort of signs of lavish behavior, which you tend to find into the peak. So, as far as I'm concerned, the cycle really has worked like clockwork. I mean, it's not to say that there haven't been very significant events, but the underlying forces that drive our economies through boom and bust are delivering the cycle once again. There's really nothing that's happened that sort of leads me to think that maybe there are things that are taking it in a different direction.
Oh, thank you. Yeah, and I just literally came back in from Washington, D.C. yesterday, and whilst I was out there, just speaking with some clients, somebody drew my attention to the fact that DC now has the greatest number of commercial available properties. It's just overtaken San Francisco. So obviously there's a bit of an exodus with the cultural side of life in San Fran. But I think Washington, D.C. coming into a situation where there's a surplus of commercial real estate, and availability of, the rentals have dropped there. So I thought that was quite interesting. Is that anything you can comment on there?
Yeah, commercial real estate is much more volatile, but in a sense, they tend not to be. It's not as big a market as the residential real estate, and also, people have longer time horizons where they can make adjustments. Is basically the point I'd make. But I think when he's talking about commercial real estate, I suspect we're not talking about logistics centers and so on, which, Amazon warehouses and so on. We're talking more about sort of office space. And, Washington's full of massive offices, and when prices get high, governments tend to move out and they try to decentralize and so on. You see that sort of thing going on in the UK as well. And that leaves gaps that need to be filled. Maybe people don't visit Washington as tourism, so hotels are empty or not as full as they used to be. So yeah, there are some adjustments taking place, and COVID really was it might not have changed things per se, but it really accelerated trends that were maybe already starting to happen. So moving people to remote working, using video conference facilities and so on. And this is just that adjustment process taking place. I don't think it's likely to lead to a collapse. at this moment in time.
So is that something that I haven't asked you before, is that within this 18.6 year cycle, is there a point where you see an expansion in technology and innovation? Is there an innovation, right? Sort of like the idea of invention as we used to call it, but now we call it innovation.
Yeah.
Does that fit into the cycle very specifically?
Yeah, it does in a couple of ways. The first is that each new cycle is started often by the rollout of a new technology, which kind of gets things moving again. It allows new businesses to start up, and innovation or invention is the driver of new business formation and employment. So it's going to kicks things off. And a very good example after the crisis in 1907, for example, was the introduction of the Model T in 1908. Or you could talk about the 1950s after the Second World War, the sort of interstate system and commercial air travel, which of course you know more about than I do. And then the 70s, it was the sort of personal computer and the silicon microchip and so on. In the 90s, it was the internet. And then I think for this one, there's been any number of technologies, but for me, the thing that has really made the difference in so many different ways has been a 4G and the smartphone. It's just it's been the foundational thing for so many different businesses, for the development of AI models, because so much more was put online and so on, and enable them to train up and so on. And of course, computing power and additive manufacturing and the blockchain and all the things that come in on top of that. And then so that was the main way in which technology can affect the cycle. The second thing is that I mentioned that the second half of every cycle is a major boom, and often at the center of that boom is a central industry, and often at that central industry is a new technology. And in my book, I cite the example of the 1840s, which was the railway boom. And so railway was really a game-changing innovation. And you could argue that AI is playing a very similar role. And by the way, I chose that example quite deliberately, being 180 years from the current time, which of course will make your ears pick up. And the railway technology was very was game changing, but the first few years of the kind of speculation, there's a lot of hype. Everyone was launching railway schemes. Some of them were fraudulent. Some of them were just not didn't really make sense. And you could argue that you're seeing a little bit of that with AI. There's a lot of AI. Everyone's saying AI this, AI that. It's going to change this. It's going to change that. Some people are scared of it. Some people think it's going to change everything tomorrow. So there's a lot of that kind of thing going on, which to my mind mirrors what we had in the 1840s. So it's a sort of thing that can pull in a lot of investment and a lot of excitement. It's a new story. And that can enable markets to go to new highs. We've already seen that with the Mag 7 so far, but it's now starting to rotate into other parts of the markets and so on. So it's an interesting historical parallel from my point of view, and it's also founded on technology.
That's fascinating because, so you've mentioned this 180-year cycle, which is effectively 10 18-year cycles. Again, we've just got the halves there to sort of play around with, but that gives it a tolerance of 5 years. But this suggests really that the technology now is going to be of a greater the impact of the present technology is going to have a greater magnitude because it's part of a super cycle as well as the 18.6-year cycle. Like you say, the railroads really did revolutionize not just America, Harriman and everybody, but also Europe as well, because up till that point, I guess people just wanted faster horses, didn't they, really? So
exactly. Yeah. And actually it's a very good point that it is going to be revolutionary, but as with the railways, it took 30 to 40 years before you really saw the full impact, before you had the networks and all the different ways in which railways could support not only people moving around but also freight and other things. I think the same thing will be with AI. Now it's sort of hype and so on, and people are sort of exploring different use cases, but it's maybe in the next cycle and the one after that we really see it being embedded in our lives, in our economies, in our businesses, in our homes and so on.
That's something just speaking about this, this is really fascinating because because back in the 1840s, from 1830s onwards, really, we saw, we talk about the 1837 top and crash that went in. That's a 5-year downturn, which really was partly due to boom and bust in railways, but it was also due to canal building around the Chicago area. But coming back to this idea that the prevalent booms and busts were based around the new industry, and that's what we saw in 1857, and we also saw that in 1876 off the top of my head, with where we got things like the Cincinnati Trust, Ohio and Cincinnati, sorry, the Ohio Trust going bankrupt because they had too many bonds that were effectively junk bonds based on railways, etc. Mm-hmm. So I'm wondering now, do you think then? So it's just an opinion question. Nobody really knows the answer to this, but on this premise that the dominant innovation or innovative technology is the boom and bust vehicle. So therefore, do you think AI is going to create the next few collapses, booms and busts? Do you think that technology could be part of it was like, if we go back to the end of the 90s, that the dot-com boom and bust came, so now it's AI. Do you think AI is the field where the danger lies potentially for a bust following the boom?
I'd say so. I mean, I'm not entirely sure how, because we have, it's only been a year since we've all introduced to ChatGPT and other things. Yeah, I mean, it's clearly the destination where a lot of investment capital is going, because it's the new story. So it draws in capital and everyone becomes exposed to it, both on the upside and then potentially on the downside. Yeah, I mean, you might find that a lot of finance related businesses are somehow using AI, and it just goes horribly wrong. And an obvious example of that would be, say, a bank that employs AI to do credit scoring and credit checking or something like that. And it kind of, and we're seeing with ChatGPT that it hallucinates and it gives you some very definitive answers, but it's total bollocks. Maybe you get that kind of scenario with a bank, or maybe it's a different thing where every bank is using AI in a particular way, and they don't see interactions between AI programs in different banks, and the financial system is all very interconnected, and so when something happens in one bank, other banks react in a certain way, and maybe people who are overseeing it don't really know what's going on, because one of the things that we know already from AI is that you don't really know what's going on underneath the hood, right? Yeah. And so, yeah, it's quite possible. And I suspect this won't be a story just for the current cycle. It will be for the next cycle as well, as you point out.
Yeah, that's just when we were just talking now, that's sort of this notion hit me. So, and of course with AI, garbage in, garbage out, right? So that's GIGO, that's and of course there is this optimism, isn't there, that new technology will solve the world's problems, and
exactly.
I think that's just human behavior, really.
It's true. It may do, but it'll create a whole load of other problems.
Exactly. That's exactly it. Be careful of what you wish for, lest it come true, right? So, yeah. So let's move ahead into 2024. Let's take a deep dive into that, if that's okay, Akhil.
Yeah, sure. Okay, I'm just going to share that previous chart again, if that's all right.
Absolutely. Yeah.
So I mean, I should say, just by way of introduction of this chart, I know I've introduced it, but I actually produced this chart in 2016. So I kind of set out, when the start of the cycle was, I set out the main phases. And the only thing I've changed to this chart in all that time is moving this yellow dot 1 year along the x-axis, so up and down the slopes in that time. That's the only thing I changed. Now, what you tend to find is that there are certain patterns that apply to each cycle. And actually, the way to really see this in depth is if you read my friend Phil Anderson's book, The Secret Life of Real Estate and Banking, where he goes through the full history of the US cycle by cycle, and you actually see how it repeats. So you have the first half, you have the mid-cycle recession. As I said, government stimulates the way out of the economy, and you get kind of looser monetary and fiscal policy, which kind of ensures that the recession at the mid-cycle tends to be shorter. They also roll out massive programs of infrastructure spending, And we have seen all of that over the last couple of years. So we saw zero interest rates, we saw massive surge of money into the economy, and then we had all these infrastructure programs. It wasn't only the sort of build back better out of COVID, it was things like the Inflation Reduction Act. You still have the Belt and Road Initiative. I know it's been going on for some time, but that's had a renewed impetus, even though it has run into difficulties in some areas. You have the EU's Global Gateway and all this kind of.
Let's just drill down into the Belt and Road, actually, if that's okay.
Mm-hmm.
Yeah.
Yeah.
So, yeah, I mean, the expansion has been phenomenal. And of course, it's been very prevalent, not just in South America, but also in the Caribbean. So, as you said, it's run into some challenges. Yeah, let's talk about that. Tell us more about your thoughts on that.
So
first of all, actually, just in case not everybody's aware, just tell us exactly what that is. Yeah.
Well, so it was, I think, launched about 10 years ago. It took a few years to get started, but it's China's. Well, it's got a number of initiatives, but it was to essentially bind through infrastructure countries predominantly across the Eurasian landmass. So, from China all the way to Europe, to the Chinese economy through rail and port and road infrastructure. And in addition to that, it wanted to create maritime routes, around the world. So it had a maritime component, and that involved South America, of course, and Africa, and places infrastructure in Africa. So it was almost a global initiative, providing capital for major infrastructure projects that improved and increased connectivity between many countries, and of course China. China being by far and away the largest manufacturer in the world, and also the largest importer in the world of particularly energy and stuff. And it's delivered at least, I don't know what the figures are precisely, but hundreds of billions of dollars worth of infrastructure investments, and will probably do as much again over the next few years. I mean, of course, there are some difficulties. There's the idea that actually countries have to borrow from China in order to fund the investments, which they then have to repay. And if they can't, then they have to give up their assets. So it's created some controversy. Incidentally, Western countries in previous eras have been accused of exactly the same thing. And in return for getting countries into debt, they've negotiated votes at the UN and other things. So it's not a uniquely Chinese issue, I have to say, to be fair to China. Exactly, it's part of big countries trying to control what smaller countries do.
The East India Company was one of the biggest examples, and the Dutch East India Company as well. So
exactly, it's a rather sordid tale. And in fact, you could argue so far the Chinese one has probably been the least sordid of all of them. I mean, there's plenty of scope for it to get a lot worse, of course, but so far I don't think it's been too bad. But I think the point about all of this is that because of COVID, because of geopolitics, because of all these other things, it's resulted in major programs of infrastructure investment. And that's very consistent with what happens in the second half of every 18.6-year cycle. Of course, and just moving up along the sort of sloping line, demand for infrastructure creates demand for commodities because raw materials are used to build these things. It doesn't mean that commodities are just going to go straight up. There's obviously any commodity market has supply and demand issues. And one of the issues that we've seen over the last couple of years, and this is perhaps one area where COVID's had a very big impact, is China's reopening, China being fairly open, then closing down completely, then sort of reopening, not reopening, hoarding commodities during times when commodity prices were low, and then, not needing to increase demand in the global commodities market afterwards, and so on. So there's lots of adjustments going on at the moment, but on the whole, commodity prices have been relatively, in my mind, they haven't collapsed, even though there's been all this sort of turbulence in many areas, and a lot of false hope and then false pessimism and so on.
Which commodities would you see as front runners at this moment in time?
I mean, they'll be the traditional ones. So, the oil, the energies, copper, iron ore. I mean, on top of all of that, we've now got sort of the green agenda. So copper is going to be very big. You have sort of batteries and other things being very prominent. So lithium is it at the moment the dominant technology for that. Of course, it's that people are looking to change that. we have, of course, the agriculturals, which I think follow slightly separate cycles, maybe more related to weather and other disruptions. I mean, you'll know as much, or if not, actually probably a lot more than I do about all these things. And so we've had a bit of turbulence from various sort of economic trends not really being established, but I think they're starting to resolve themselves, to my mind, as we end 2023. I mean, the other point to make, of course, is that commodities tend to do a lot better when the dollar is falling. And because of interest rates and inflation trying to get that under control and so on, dollars surged. And that's caused a lot of issues in various places, but also in the commodities markets as well. So I see some of that starting to resolve itself now. And the news has definitely changed some of the kind of trends that I think will take us to the end of the cycle of now starting to reveal themselves as we move into 2024. As you move into the final years of the cycle, markets tend to move into all-time highs. We've seen that with many stock markets. I mean, actually, quite a few stock markets this year are poised or at all-time highs. And then you get what I call the era of very easy money. Now, when people say, oh, very easy money, we've already had that. It's become much tighter now. I'm not talking about what the government is doing. I'm talking about what banks are doing. And what banks love to do is lend money. And what they really love to do is lend money to real estate, because you can extend a loan for 25 years or 30 years, pays interest for all that time. And you only have to do one set of due diligence. And typically that's computer based. So it's your costs are low and your profits are, or your revenue is significant. And the great thing about real estate lending is once the person has paid off the loan, you can extend another loan on exactly the same piece of real estate for another 25 years. So it's like an earnings carousel that just keeps going round and round. And actually, in fact, when interest rates are high, banks make bigger profits. So they do want to, lend more in this environment than when it was zero interest rates. So you tend to find that banks are competing with each other to grab market share. That means there's a lot of availability for loans. And as property prices in particular rise, people have to borrow more. You're starting to see deposit requirements going down. You're starting to see banks not requiring too much proof of income. And so all the things that we saw in the 2000s in the equivalent point in the last cycle, you're starting to see again. So I think these are some of the major kind of trends that are going to take us through 2024.
I think that's fascinating. So basically the stock market's going to be heading up, really. Is that how we read this?
That's how we read this. And it's going to be powered by, sort of more positive news. And it's going to be, I think, also the prospect of higher earnings in the future is basically what the stock market is pricing in. And so I see that as how things are going to play out. Of course, there are some warning signs which you might want to talk about. But that's my overall thesis.
Well, let's come to those warning signs in a moment. I just want to back up onto the commodities thing. 90-year cycle from the Dust Bowl coming in. So I think there will be some stresses there. We can talk about that some other time. Let's come back to the challenges and stresses. Well, before we do that, the presidential cycle coming in, typically in the election year, I'm just glancing over, it tends to really sort of head up, doesn't it, really? So, overall into round about September, October, a little bit of a pullback in March. Any thoughts on that? Do you think that's going to do pretty much the same thing this year, or do you think we're going to be more bullish? Or and let's talk about the threats that you're seeing as well.
Yeah, you're the expert in the stock market, so I'll leave that to you. But in terms of the politics of it, and a general point is that when an incumbent is running for re-election, in particular, they're doing everything they can in the year before and the year of an election to get re-elected and therefore to stimulate the economy. So it's no surprise that Powell has now said just before the end of the year, no more interest rate rises. He's taken a very different tone. I'm sure that Biden is telling him it's got to be very positive in 2024. Central banks aren't quite as independent as people think they are. So I think that's the general backdrop. So quite good for the economy, quite good for the stock market and so on. And of course, there may be pullbacks and so on. Now, the warning sign I'd have is also related to that is this will be one of the most bitterly contested elections in US history, and US history's got plenty of contested elections. But you've got a situation where one side doesn't believe the last election was fairly won. You've got some states saying, well, this guy tried to overthrow the government. He's not fit to run. He can't run. It's illegal and so on. That's been challenged all over the place. I'm not sure that many people on Trump's side will accept any decision by any court. So, and there's a prospect of conflict, violence, who knows? And markets don't like that sort of uncertainty. And so it's possible that this blows up and it creates problems in the markets. But if absent something really ridiculous, then you'd expect 2024 to be a fairly bullish year for stocks. At least that's the way that I see the presidential cycle. But of course, more about that than I do.
Well, I think we've, when we looked at the last election, we knew it was going to be contentious. You're looking at the 144-year cycle, so just exploring that and what happened with Ulysses S. Grant. So there are clues there, and I think the other thing to bring in for America, for the United States, is that we are in these civil war cycles, this 82 to 84-year pattern, and we are, accelerating in that. So, previously these divisions have been over race and color, and I think now they're going to be over ideology. So I think it's going to move towards red versus blue. And just as I said, I was in America yesterday, and I saw the approval ratings for Biden with regards to Bidenomics are down as low as 14%. So things are not looking very stable anywhere in that respect.
Yeah, so it's good. And Trump's approval rate, well, he's obviously not in office, but his whatever ratings are looking quite strong. So, but these things, I think it'll be much closer than the current polls are suggesting, because Biden is in the position of being the incumbent, and if it's actually also fairly rare for an incumbent to be removed when you're actually in an expansion, so when the economy is growing. So I think that it would also be quite rare for him to lose. So he'll have a big chance, which obviously means that more conflict and more aggro and more heat and stuff. So I think I've said that markets will be up, and I've said trends are established. But one thing you can guarantee is that the news will be all over the place, because it's going to be so many different things going on. See, media loves conflict because you can write lots of stuff about it. And so emotionally, I think it's going to be a very turbulent year. I don't think it's going to be very easy to navigate.
So let's set this against the backdrop of the DecSenal pattern, which certainly I use a lot, and I know you do. And what we tend to see is that years ending in 3 are bullish, and so far that's proven to be correct. Years ending in 4 are less bullish, but are still bullish. This is looking at Dow data going back 122 years. So that does suggest a bullish market, but maybe not as strong as this present year. And then, of course, years ending in 5 historically have seen quite large runs up. So just projecting ahead to 2005, looking at the way you showed us the cycle there, do you think, I mean, that certainly supports this idea that we could get a strong boom in the stock market all the way into that peak for 2025, 26? Is that a reasonable understanding, or do you want to put some caveats on that, Akhil?
No, I mean, it fits the DecSenal pattern. I mean, years 4 to 6 tend to be, if anything is straight up, it tends to be those years, this sort of second half of year 4 all the way to sometime in year 6. And that's very consistent with where we are in the real estate cycle. The final years, you expect them to be in some ways the most bullish years, peak around 2026. It fits that perfectly. Again, it's always subject to events and other things, unforeseen things, but it's kind of my working hypothesis that it'll take something fairly significant for that not to happen. I would say, and just by way of, it's not a caveat, but you know how you tend to find the final years of the decade tend to be strong. They are strong if the real estate cycle context is supportive. And a very good example of that is 2008. So 8th year is usually a strong year. But of course, in 2008, because we're in the financial crisis at the end of the real estate cycle, it was pretty much down all year. So that's I think that's kind of how I fit the two cycles together.
Fascinating. So, do you have any closing thoughts or overviews that you'd like to offer to people viewing this presentation?
No, not really. I mean, I should have maybe said at the beginning that I've been studying cycles, obviously not as long as you have, but for a good sort
You're
of.
telling me I'm old.
I know, just you got into it earlier than I did. But I'm now in my second decade of cycle study, should we put it that way? And I think the reality is that history has quite definitive patterns if you know what to look for, and it's often hard to spot, particularly if you're not dealing always with numerical data. But if you understand those, it's then gives you a working hypothesis, and then you've got to be fairly light with your sort of forecast. You treat the market in the market's context. You look at what's going on in the price chart and so on. So having said all of that, I think that I haven't seen anything that has been quite as stable as the real estate cycle. And one of the reasons why I'm so confident in it, and as I try to outline in what I write in my book and elsewhere, that it is not just based on price patterns. It's also related to fundamental laws of economics, and when those are very stable, and unless they're changed somehow by changing the way we structure our economies and so on, you can pretty much guarantee that the cycle will repeat in some way. Then the trick is to be able to spot it repeating when all the news and all these other things are trying to distract you. And so that's, I think, behind some of the fairly, what I've tried to be fairly definitive about my views about what's going on in this interview. And that's the basis for it.
I think it's absolutely fabulous. I mean, that's a challenge that all of us face in the work we do, be it in markets or forecasting, geopolitical strategy, whatever it is the ability to define the signal and extract that from the noise. And I think that's a very clear point. And I think that's a great point to conclude this interview. So, Akhil, thanks very much. It's been fun discussing 2024 and also looking at the full cycle with you. So, wishing you a very happy, successful and prosperous 2024, and looking forward to seeing you again, both for more presentation work, but also for another nice bottle of red or something. So take care, and a happy new year to you.
Thank you so much.